Today, we're going to dissect a moment in very recent history, when the entire world seemed to hold its breath. A time when the gleaming, complex machinery of global finance, an engine that created unimaginable wealth, didn't just sputter. It seized, it buckled, and it threatened to drag everything down with it. This is the story of the 2008 financial crisis, and it's a tale of breathtaking arrogance, of numbers so vast they almost become meaningless, and of a frantic, desperate rescue mission waged in back rooms by a handful of people who suddenly had the fate of the global economy resting squarely on their shoulders. So, let's pull back the curtain and see how it all came apart.
You know, this single sentence just perfectly captures the spirit of that age. See, Wall Street in the early 2000s wasn't just a business, it was practically a religion. There was this fervent belief that risk wasn't some beast to be feared anymore, but a puzzle that could be solved. They had their complex models, their algorithms, Nobel Prize winners on the payroll. They genuinely believed they had engineered the very idea of failure right out of the system. And the profits? Well, the profits were godlike, which only seemed to confirm their genius. But the truth is, they were all walking on a razor's edge, and the drop on one side wasn't just failure, it was oblivion.
So how did they get to such a dangerous place? Well, it didn't begin with a bang. It began with a flood of money so enormous that it simply had to find somewhere to go. This was truly the age of hubris, an era where the very foundations of the global financial system were being rebuilt on what looked like solid ground, but was really just perpetual debt.
Right, so after the dot-com bust and 9/11, the U.S. Federal Reserve did what it always does to stimulate the economy. It slashed interest rates, making money incredibly cheap to borrow. At the exact same time, you had this savings glut in Asia, which was pouring trillions of dollars into global markets. The result was this unprecedented ocean of cheap credit. This money, this liquidity, was the fuel. And Wall Street, well, they had built the most powerful, and as it turns out, the most dangerous engine imaginable to burn it.
At the absolute heart of this entire crisis is one single concept: leverage. Just think of it like buying a house. You put down a small amount of your own cash, your down payment, and you borrow the rest from the bank. Now, if the value of that house goes up even a little bit, your return on your small investment is huge. That's leverage. It's the accelerator pedal of finance. The problem, of course, is that it also means a tiny dip in value can completely wipe you out.
And this brings us to what might be the most terrifying number of the entire era: 40-1. This wasn't some abstract theory. This was the reality inside massive firms like Bear Stearns and Lehman Brothers. As the official Financial Crisis Inquiry report later laid bare, these titans of Wall Street were operating on a sliver of their own capital.
Just let that sink in for a moment. A wobble of less than 3%. For these gigantic firms with literally trillions of dollars on their books, a slight downturn in the market wasn't just a problem to be managed, it was an extinction-level event. Their entire empire, the record profits, the skyscraper headquarters, the whole shebang, it was all balanced on the cushion of capital so thin it was practically transparent. The system wasn't just risky, it was breathtakingly, terrifyingly fragile.
For years, the models worked. The profits just kept rolling in. That feeling of invincibility, it felt real. But then, in the spring of 2008, the whispers started. The theoretical risk, the one they thought they had tamed and engineered away, began to claw its way into the real world. The first great crack finally appeared in the facade.
The thing about a modern financial collapse is that it's not a slow decline. It's like falling off a cliff. On a Monday, Bear Stearns was an 85-year-old institution, a pillar of Wall Street. By Thursday evening, its CEO was on the phone with regulators, telling them it was about to run out of cash. By Friday, the stock was in absolute freefall, and by Sunday, to stop a full-blown bankruptcy that could have poisoned the entire system, it was sold for pennies on the dollar in a deal frantically brokered and backed by the U.S. government. A titan had literally vanished in less than a week.
Now here's the crucial, almost ironic part. The government's intervention was meant to be a firewall. It was supposed to draw a line in the sand and say, the panic stops right here. But the market heard a completely different message. The market heard that the monsters under the bed were real. If a firm as big as Bear Stearns needed a government bailout just to survive a weekend, it meant the rot in the system was far deeper and more widespread than anyone had dared to admit. So instead of calming nerves, the rescue sent a jolt of pure terror through global finance.
And this was the question that was suddenly echoing in every trading room from New York to London to Tokyo. The illusion of safety was completely shattered. The market was now this wounded, paranoid animal, sniffing the air for the very next sign of weakness. The fall of Bear Stearns wasn't the end of the crisis. It was just the prologue.
6 months later, that terrifying question got an answer. The aftershocks from Bear Stearns had been rumbling all through the summer of 2008. But in September, the main seismic event finally arrived, the one that would turn a serious crisis into a global catastrophe. And it was all triggered by the fall of Lehman Brothers. This slide really shows you the stark contrast at the heart of the entire crisis. You have two massive investment banks, both drowning in toxic mortgage assets, both leveraged to the hilt. In March, the government decided Bear Stearns was too interconnected, that its failure was just too dangerous to risk, so they stepped in and orchestrated a rescue. But in September, with Lehman Brothers on the exact same precipice, the authorities made a different and truly fateful choice. They let it go.
So why the completely different response? Well, it was a toxic cocktail of philosophy, politics, and, frankly, a fatal misjudgment. First, you had this idea of moral hazard, this deep concern that if you keep saving reckless firms, you're just encouraging more recklessness. Second was the political reality. The Bear Stearns deal was slammed as a bailout for rich bankers, and there was absolutely zero appetite in Washington for another one. And third, and this might be the most crucial part, there was a belief, or maybe a hope, that the market had priced in a Lehman failure, that the system could now absorb the shock. They were dead wrong.
And so the unthinkable happened. Lehman Brothers, an institution that had survived the Civil War and the Great Depression, was gone. And this wasn't just another company going bust. This was like pulling the keystone out of the arch of global finance. The credit markets, which are really the essential plumbing of the entire world economy, froze solid, almost overnight. The chain reaction that regulators had been so terrified of in March was now happening, and it was happening with a speed and a force that was just staggering. The failure of Lehman wasn't the end of the story. No, it was the catalyst for a full-on global meltdown. In the frantic hours and days that followed, policymakers were faced with this agonizing series of choices, and every single one revolved around a single explosive concept. This is the idea that haunted every meeting, every late-night phone call. It's the realization that some companies aren't just companies anymore. They've become pieces of critical infrastructure, so deeply woven into the fabric of the system that their collapse would be like pulling a central processor out of the internet. It wouldn't just hurt the economy, it would literally break it.
And if you want the ultimate proof of this concept, you don't have to look very far. Lehman fell on a Monday. By Tuesday, the world's largest insurance company, AIG, was just hours away from bankruptcy. Having just made a stand on principle by letting Lehman die, policymakers were now staring into an even deeper abyss. An AIG failure would have dwarfed Lehman's. So they did a complete 180. They bailed out AIG with an astonishing $85 billion loan. The principle of moral hazard had just collided with the reality of total systemic collapse.
And this brings us right back to that core dilemma. If you save AIG, aren't you just telling every other massive company out there that it's okay to gamble? That if you win, you keep the profits, but if you lose, don't worry, the taxpayer will cover the losses? That is the textbook definition of moral hazard, and it was the central, agonizing paradox of the entire crisis.
The choice they faced was incredibly stark, and both sides had a powerful case. The argument for intervention was pure, pragmatic fear. As Treasury Secretary Hank Paulson bluntly warned, without bold action, they were facing a depression that could be deeper than the Great Depression. The alternative was economic Armageddon. But the argument against was about basic fairness. Why should ordinary people have to pay to clean up a mess made by the wealthiest players in a game they never even got to play? It was this impossible choice between systemic survival and moral justice.
In the end, as we all know, survival won out. The system was pulled back from the very brink. But the crisis left behind deep scars and a set of profound, lingering questions about the very nature of modern capitalism. Questions that, frankly, we're still grappling with today.
Right at the heart of this storm were these three men. Hank Paulson, the former CEO of Goldman Sachs, now Treasury Secretary, Ben Bernanke, a scholar of the Great Depression, who was suddenly living out his own worst academic nightmares Fed chairman, and Tim Geithner, the man on the ground in New York. They formed this uneasy trinity, forced by necessity to improvise policy on an almost hourly basis, making decisions that would end up reshaping the global economy for a generation.
All those ad hoc bailouts of Bear Stearns and AIG eventually culminated in a much more systematic approach, a request to Congress for an unprecedented $700 billion. The Troubled Asset Relief Program, or TARP, was essentially a bazooka aimed at a raging forest fire.
It was deeply controversial, of course, but it was the tool they used to inject capital directly back into the banks and finally thaw the frozen credit markets, pulling the whole system back from the edge of total collapse.
And this, perhaps, is the most important lesson of all. The frantic efforts to save the system were probably necessary, but the real work came after. The work of understanding why it broke. Why did the models fail? Why was the risk so misjudged? Why was the hubris so blinding? Because a system that survives a near-death experience without learning anything is simply doomed to repeat it.
And that leads us to our final, and I think, most provocative question. New regulations were passed. Capital requirements for banks were raised. But is the system truly safer? Or did we just patch up the cracks in a fundamentally flawed structure? The concept of too big to fail still exists. The incentives for taking huge risks are still there. And the memory of the abyss, well, it's faded. And you really have to wonder, as you look at the markets today, whether the lessons of 2008 have truly been learned or merely forgotten.